Hello and welcome back to another episode. Today's episode is all about the SBA 504, and we're really going to focus on construction loans. We have our repeat guest back, Carrie, and Carrie's here, and we're going to dive through a series of questions all about the SBA 504 and specifically construction loans. So to start it off, what is an SBA 504 loan? Can you explain the structure for people who don't know, Carrie?
Okay. Bo, in a nutshell, a 504 loan is a hybrid between a bank conventional first and an SBA second. And in most cases, it's 10% down, 90% LTV. That LTV can decrease if it's a startup or if it's a special use property. So if both of those apply, then it would be 80%, or if just one applies, it would be 85%. And the bank I work for, we provide the 50% first lien. And then we have relationships with CDCs nationwide, and we work closely with them for the SBA portion. So that's kind of it in a nutshell.
Thank you. Okay, the next question, Carrie, what is a CDC and what point do we get a CDC involved in the transaction?
Okay, CDC both stands for Certified Development Company, and I believe at last count there are about 230 nationwide. Some are good size, some are small. And when we get them involved, normally is when we send a commitment letter out. But there are some circumstances where we have to expedite the loan process. So sometimes, personally, I'll get them involved as soon as we get the loan package in and send them the file. And so they can underwrite concurrently with our underwriter. So that would speed up the process probably by about 2 weeks.
And so what I'm hearing, if I hear you correctly, Carrie, it's best to figure out the bank you're going to go to first. Let them work on it. Let them say, yeah, this is something we can do. And then usually that banker or BDO, whatever we want to call them, will usually have referral sources in the CDC space because not all CDCs are the same. Some are better than others.
Bo, that is correct. And when you're seeking out a first lien lender, you want to make sure they're experienced with 504s. Our bank is very experienced with 504s. We've got staff management with decades of experience with 504s. So a lot of SBA lenders concentrate on 7A, and they might do 1 or 2 504s a year, but there's certain banks out that specialize in 7A that also specialize in 504s, like our bank.
Okay, thank you. Next question. What are the advantages of an SBA 504 construction loan versus a conventional
loan? First and foremost, it would be the lower down payment. If it's not a startup, it's going to be 10% down, and so that's the biggest advantage. Another thing is if someone's seeking out a conventional loan for construction, they're going to have to pay closing costs out of pocket at closing. With a 504 loan, those are financed into the loan. So those are probably the two big things. Our bank factors in a interest reserve. That's included into the total project costs. And a lot of banks don't do that as well, even conventional banks. And what that interest reserve allows to happen is it makes the interest-only payments during construction. And so it's no out-of-pocket for the sponsor.
Very good. With banks tightening up, do you expect the SBA construction loan to be one of the few loan products that is still being aggressive in this market?
Well, that's a good question, because a lot of banks have actually suspended their construction programs and even eliminated them, and we're still going strong. So out on the street, we're definitely hearing that a lot of banks have suspended their construction. But banks like ours that are still doing construction, we're still very aggressive seeking out construction loans.
Okay, great. How long does it take to get approved for an SBA 504 construction loan between the CDC and the bank approval? What can you walk us through what that looks like?
Sure. But there's a lot of moving parts to the process, obviously, because a lot of things factors on are plans ready? Have they engaged a GC that has got reached out to an architect? The GC always applies for permits too, so it depends where they're at that process. In a perfect world, if we get a construction deal in, they've engaged an architect and they started the process, we can close a construction loan the same time it would be like, say, a purchase or a refinance, usually 60 to 90 days. But we've had some construction loans that take longer only because and every city and county is different with their process. So as far as Some cities are quick approving permits and plans. Others take months. So there's a lot of variables there. But once again, if a lot of people do their homework and are ready when they're ready to seek financing, and in that case, we can close in 60 to 90 days.
Yeah. So if anybody's watching this, basically, if you have, your construction budget, if your GC lined up, their insurance, all the documents up front, you're going to close in 60 to 90 days. The ones that take longer are if you don't have permits, because permits got to be basically in hand for the loan to close. So just so you know, that's really the big holdup. SBA loans really don't take much longer than a conventional loan. It's really just basically the sponsor getting their, budgets and everything together. So keep note of that. They're closing just as quick. And Carrie, your bank, from getting a complete package, you guys are pretty darn quick on issuing your commitments.
Well, that is correct. We've got at last count maybe 6 or 7 underwriters on our SBA staff, and quite a few of them are very experienced. And normally we can get a commitment letter out within 1 week.
Very good. What are the interest rates and terms for an SBA 504 construction loan? I think people probably want to know what the second is, what the first is, what the prepayment penalties are, that kind of thing.
Okay. Well, let me start with the SBA piece because that's easy. Because the SBA portion is it's a fixed rate for 25 years, and at the time of this podcast here in April, the CDC rate debenture rate has actually gone down from previous months. It's right now at 5.88. It's been in the 6s for a while. So that loan is fixed for 25 years. As far as the bank first lien, that's pretty much up to the individual lender how they want to price. For example, our bank is, as you know, because we've done some 504s together, we have a 33-year term. First 3 years are interest only. And then in year 4, that's when the amortization kicks in. So, and we're prime +1. So that really helps as far as with that, when you have those interest only payments the first 3 years and the 30-year amortization, it effectively makes the interest rate 1.5 to 2 points lower. So that helps out. And of course, we're all hoping and predicting that the prime rate will go down, and they're saying that it should be in the 5 to 6% range. So hopefully we'll be there within a year or two.
Carrie, I was just listening to something from the SBA, and it seems like they're going to get away from the prime rate at some point here. I don't know.
Really? That's got to be for 7As, right? I would imagine.
Maybe probably just 7A. I just heard it the other day. I was listening to the SBA call. So interesting.
Really? Okay.
Yeah, I'll send you the link. And so I was figuring it's probably just 7A, not 504, but it's pretty interesting.
Absolutely.
Okay. Next question is, what types of businesses are eligible for an SBA 504 construction loan?
Okay. Most everything that's owner occupied at 51%. And if it's an eligible property type or business type for SBA, as you know, there's certain industries that aren't eligible, real estate development, gambling entities, like that. But it can run the gamut between an athletic facility to a warehouse. So as long as it's owner occupied.
And Carrie, if it's new construction, they got to occupy how much percentage?
I'm sorry, I said 51% before. If construction, it's 60%.
Right, guys. Just to clarify, on existing building, if you're buying an existing building, you need to occupy 51%. If you're doing new construction, you have to occupy 60%. And they say within the first 10 years, you're supposed to occupy 80%. I don't know how they're tracking that, but that is their rule. Okay.
Thanks for clarifying that, Bug. I know I said 51%.
I'm a good student. I've been learning. There we go. Okay, next question. Will they allow for equity from another property instead of actual cash injection? Will they ever allow, if the sponsor's got a lot of equity in another property, would they ever allow that kind of like a cross-collateralization? Or do they usually have to pull a line of credit on that subject property?
Okay. There's 2 different scenarios in relation to that. A lot of construction deals we see, the sponsors have already purchased the land. Some pay cash for it. Some have put a large down payment on it. And that equity in that land can be the injection for the new construction project. And to answer your other question, let's say they have equity in another commercial building that's eligible for SBA financing. In our bank's case, we probably want to refinance the loan on that other property. So we would be in first position. Then that entity can be a co-borrower on the new construction project. So to answer your question, yes, it can be structured to where equity in another building can be used for the injection.
So you can get pretty creative with that.
Yes.
Okay, cool. How much down payment is required for an SBA 504 construction loan?
If it's not a startup and if it's not a special use property, 10%.
And can those funds be brought in by a partner that owns less than 20% of the entity, maybe like an investor partner?
Yes. And we see a lot of cases like that. Now, if that investor, this is rare, but if that investor is part of management or the day-to-day decisions, our bank would definitely ask for that person to be a guarantor, or at least a limited guarantor.
But if it was just an investor that wanted to, have an equity position in it, that would be okay.
Yes. Of course, our bank likes to see skin in the game from the borrower, but the funds can come from an outside investor with a minority ownership interest.
Very good. And do they allow for seller carryback as well on like an acquisition?
Yes. Once again, that's kind of a bank call too. If we have a seller carryback in the structure of the loan, we like to see at least half come from the sponsor, then half can be a seller carry. Now I've seen deals where seller carry is 100% of the injection on 504. We just have to count that payment into the debt service on that seller carry.
And unlike the 7A, that seller carryback does not have to be on standby. Is that accurate?
That is correct. And they can receive payments as well.
Oh, very good. Thank you. What is the maximum loan amount for an SBA 504 construction loan between senior debt and the SBA piece?
Okay. That's for the third-party lender like our bank. That's a case-by-case case-by-case answer.
But you can get $17 or $18 million deals done.
Yes, you can. And once the $5 million allotment is used up, the SBA allotment is used up, the bank first lien can be higher than 50%. So that would allow to get to those higher loan amounts. I see some CDC websites, they say, hey, loans up to $20 million, and that would be attainable if the first lien lenders will take that additional risk.
If it's a very strong sponsor and a deal, then yeah, we do see those. Then that leads us into our next question, which is, what are the advantages of the SBA 504 green loan for construction projects?
The biggest advantage is that it gives you extra SBA allotment. You can do three more projects up to, and I think on a green project, the SBA piece goes up to $5.5 million. So once the sponsor uses up their initial $5 million, they can do three more projects at the $5.5 million SBA allotment.
So $16.5 million total SBA aggregate,
right? Which
really, if depending on what the senior debt is, it could be, you could be doing that could be like $40 million in total deals.
Even more if they're all big projects.
So this is a viable, option for a lot of like developers that are running their self-storage businesses. Like we see a lot of people doing these large self-storage construction projects. This is a great product for them to use.
Absolutely. And our bank does a lot of self-storage loans. So we see that all the time.
Hi, if you'd like to book a call with me and discuss SBA financing, whether it's a 7A or 504, or you just don't know where to start, maybe it's a startup business, you're buying an existing business, you're buying a franchise, you're building a new office building, you want to expand your existing business, we have multiple solutions. I can walk you through the 7A and the 504 and the SBA loan process. And if you have any other questions on any other types of financing, I'm happy to book a call with you. The link's below. Look forward to seeing you soon. Here's the next question. Is it possible to do a SBA 504 with a 7A for working capital in conjunction? Then let's just say it's a construction project and it was self-storage and they needed some working capital and, employee a couple months. Could you potentially do a 504 with a 7A?
Well, absolutely, and our bank does it all the time. But here's a perfect example. I currently have a loan that's going to close, I think, probably the end of this month. It's a franchise restaurant, and we did a 7A loan for them, basically a piggyback loan. It would be in third position, and it's for their inventory, for working capital, just items that aren't eligible for a 504 loan. So we can definitely do a 7A as far as for those items, working capital, inventory.
Very good. Next question is, how does the draw schedule work on an SBA 504 construction loan? How did the contractors get paid?
And I've worked with 3 different banks that offer construction, and all 3 basically have the same policy that the invoices are submitted and normally paid at least once a month, usually towards the end of the month. So I guess there's some kind of lien waivers they have to research and everything. But normally once a month, they submit their invoices throughout the month, and then we pay them, and then we go on to the next month.
Very good.
And I'll just let me interject here.
Okay.
I've worked on a couple loan scenarios where here's another example of another deal that I'm working on. It's a laundromat, and the sponsor has the opportunity to buy his machines before construction is complete. So he can get a draw to buy those machines and store those machines, and then wait for and then place them when the contract is ready. So I mean, we can actually advance funds for equipment, as in this case.
So the 504 can also fund FF&E too, furniture, fixtures, and equipment. Anything?
Technically, it has to be long-term equipment. Like in this case, it's this coin-operated laundry for his machines.
Okay, now the last question of this session is, a lot of people get confused on, what the debenture is, and can you kind of walk everybody through and let them know how the process works, where it's actually the bank making the senior debt and the junior debt, which is going to be eventually, the SBA-guaranteed piece, but they don't realize that the bank is funding that all as a construction loan in the beginning. Can you kind of just break it down how that works, and then the debenture?
On a construction loan, the debenture can't fund until construction is complete and they have a certificate of occupancy. So what most banks do, and our bank is no exception, we provide an interim loan to cover the CDC piece, so the loan can full fund, and we close 2 loans in the same day. And then as far as the debenture goes, I mean, there's investors that fund that, and it only occurs once a month, usually about the middle of the month. So let's say what we use current time frame. Say a loan closes at the end of May. It may be the middle of June or the middle of July before the debenture funds.
Very good, very good. Yeah, a lot of people get confused on that, and so that's why I wanted to point it out. And so the SBA rates are coming down. Hopefully they keep on coming down. I think that where your bank really excels is like these construction projects. Like when your bank likes a deal, you guys will go, leaps and bounds to get the deal, which is really cool to see a bank being aggressive, especially in the market right now where most banks aren't even doing construction loans. So it's good to see that. Do you have any insight on what your bank's, appetite is? That has it changed at all, or is it pretty much the same thing as it was prior to this big bank failure happening?
We've one big change our bank. We used to do smaller 504 loans, so we've kind of raised the floor up to where it's like $4 or $5 billion. So we're doing a lot more 7As for the smaller loans. But we haven't. Aside from that, we really haven't changed our focus on aggressively seeking construction loans. And each lender has their own appetite about the industries they like to finance. 3 that we don't touch are hotels, gas stations, and car washes. And a lot of banks, I mean, those are high risk loans, and a lot of banks don't fund those. But there's some banks that like them. And I've got friends in the business who will welcome a gas station or welcome a car wash or whatever. But we do a ton of industrial. We do a lot of medical facilities, daycares. Right now, I've got a loan in the pipeline for a veterinarian clinic. So we do restaurants, but a lot. We just don't do those 3 I mentioned. But other banks have an appetite for those.
Very good. And so when do you think it's best to do a 7A versus a 504 for a construction project? Obviously, if it's a small deal, what other times would it be better to do the 7A?
It would depend on the long-term, what the long-term goal is for the sponsor. If they just want to, if they're looking to sell the building in 5 years, they might want to go to 7A because a 504, as you know, Bo, has a 10-year prepay on both the bank first lien and the CDC piece. Some banks have a 5-year prepay, but banks can be flexible on the prepay, but the CDC is definitely 10-year. But to answer your question, it would be like the smaller loan, as you mentioned, and their outlook as far as what their future goals are for that business and property.
Okay, last topic I want to talk to you about today is the SBA 7A to 504 refinance. Right now, SBA 7A loans are in the 10s, 10 and 10.5, because Prime's at, what's Prime at? Do you know?
As of today, it's at 8%. They're predicting another quarter jump in the next. I guess the Fed's are going to meet in like 3 weeks. So hopefully it'll level off and start coming down.
So okay, if Prime's at 8, we know the maximum margin is typically 275. So that puts them at 10.75. Some people have so if you have real estate, some of these SBA 7As are looking to refinance. And so that might be a viable 504 refinance. Can you talk high levels of what the 504 refinance, what the general qualifications would be from a 7A to a 504?
Absolutely. I remember when they changed the refinance rules for 504s almost a couple of years ago, the CDC thought they were going to get swamped with 7A refinance requests. However, it's real tricky because on a 504, 85% of the original loan proceeds from the 7A have to be towards or eligible 504 items. So there's like a 15% cushion there, as long as that 15% went towards the benefit of the business. So as an example, the SBA loan authorization for a 7A breaks out how those funds were used. And I had a deal where we were like 82% eligible. So we missed it by 3%, and we couldn't do it. And we were so close. So, but in order for that to happen, it has to be 85% eligible, 504 eligible from the original use of proceeds from the 7A. If it's a straight, if all the financing was used just for the purchase of a 7A, it's automatic. We can do something like that.
Very good. Yeah. There's so many people right now that are looking to, get away from their day job, per se. And so people are looking at, becoming operators of self-storage, and people are buying childcare facilities or building childcare facilities. I mean, the SBA product is by far it's really like, if you can utilize SBA, it can really accelerate your financial freedom. I think it's like,
well said, you're 100% correct.
We're doing a lot of just business acquisitions on 7As right now, and I'm watching people buy these boring service-based businesses that spit off $400,000 or $500,000 of SDEs, and they're getting in with very little money. So like, utilize these loan products and these tools to grow your net worth and grow, and maybe even get out of your day job if you wanted to. I mean, it's just amazing what these SBA products can do if you understand how they work, and the high leverage you can get. You can't get it anywhere else. So that's why SBA is guaranteeing a portion of these loans. So guys, like, take advantage of what the wonderful federal government enacted for us to start businesses and employ people and create prosperity, which is an amazing thing.
Well, I agree. Once again, 100%. The SBA loans are a great chance for an entrepreneur to just blossom and be successful and own their own business.
Are you trying to escape the W-2 rat race? Or have you always wanted to own your own business? Have you ever thought about owning a franchise? If so, franuniversity.com can help. Our training program teaches you everything you need to know about franchise ownership, from choosing the right franchise to launching and running your business. We have the resources and specialists to help you from A to Z. You'll gain the skills and knowledge you need to succeed as a franchise owner. The best part, it's free to join. Go to franuniversity.com.
Let's just talk about SBA and why self-storage might be, why the 504 loan might be a good option for self-storage, whether it's a stabilized property or ground up construction?
Well, Bo, it wasn't until 2010 that SBA actually allowed the financing of self-storage. They first viewed it as a passive investment, but from 2010 on, the SBA has allowed financing of self-storage as they saw it as a viable investment for entrepreneurs.
And that really opened up the door to a lot, because where else can you get really good financing, high leverage like SBA financing? Now, borrower meets all the credit boxes. Maybe they're a W-2 employee at the time. They want to buy their first self-storage building existing with cash flow. They don't have experience. They're going to have the right maybe employees on site and so forth. How does the underwriter look at that? Well, first off, will they cap it usually at like an 80%, or will they go to 90% because it's a cash flowing business already?
In that loan scenario, as long as the property has been in existence for over 2 years and it cash flows, and hopefully the borrower would have some kind of business experience, either management experience, retail experience, but he could actually hire a management company to run the facility and still be able to get or purchase the facility with 10% down. Now, the management company, their agreement has to be approved by SBA. The SBA's main concern is they don't want the management company to have too much control. And usually the smaller management companies, if their agreement is not approved by SBA or is not SBA compatible, they can modify it. I know of a couple of companies that we've worked with that I've closed deals with where their management agreements are approved by SBA.
That's very good to know. So you can get 90% leverage. And when we say 90% leverage, you're also able to finance some of the closing costs and the SBA fees within that 90%. So it's really, where traditional loans, you're not able to finance those certain costs. Can you kind of explain what costs you can finance within this 90% loan to cost?
Sure. Obviously, the third-party lender fees can be financed. That's the appraisal, environmental, title, everything. And then each bank has their own fees that apply to the loan. For example, like 1% origination fee, and on every 504 loan, we have to pay the CDC a half a point as well. All of those fees can be financed into the bank first lien. And I know we've talked about this in a previous podcast before. The CDC piece, we do a bridge loan for. And because it takes 60, 90 days after we close both our bank first lien and the bridge loan before the CDC can close. Any fees involved with those two loans could be financed.
Okay, now let's kind of walk back on a scenario. A buyer wants to buy the debt service coverage is still there, might be a little weak, but there's a large value add component, and they want to include some CapEx, some repair renovations into the budget, and it's their first self-storage. Assuming that the debt service coverage ratio is in line, can we finance 90% of total costs, including repairs?
Would have to get back to, like, say, a management company again, or a strong consultant in the industry, because hopefully those improvements would increase occupancy, and then either their CPA or the management company or a consultant can prepare some projections, and then that would be key to whether a bank like ours would like that loan, just based on the projections and the assumptions for those projections. For example, a borrower could. I had a recent deal where the smaller units were selling faster than the bigger units, so he got extra cash or extra loan proceeds to convert the larger units into smaller units. So improvements like that could help increase occupancy.
Wow, that's good. So there's options, and I think it's really there. What I hear Carrie saying is he can, when you're giving him these scenarios, he's going to help structure. He's going to give you pointers on, how to get the deal sellable to the underwriter to sign off on it, essentially. So what he was saying is that, yes, you can potentially finance the CapEx or the value add component, the rehab of the self-storage, but you're going to have to show that extra, let's say it's $500,000 of renovation or CapEx, that additional proceeds is going to add increased occupancy, which in turn will increase revenues to support the loan balance.
Another example is I had another deal where they converted regular units to climate controlled because there was more of a demand in that market for climate controlled self-storage as well. So that's another scenario. Because
we often see a value add type of deals, investors out there that are doing self-storage, they come and they found like something that's mom and pop owned, and then they want to bring technology into the self-storage facility, different like keyless access and so forth. So those sometimes would be a good fit for SBA 504. A lot of investors sometimes will buy it with bridge money because they want to do the value add and then refinance with SBA would be an option as well. But if you could do it all at once, the best cost of leverage is an SBA 504 loan on something like this. So compared to like doing it in 2 steps and having to refinance, you could do it all in one loan, or actually 2 loans. Let's talk about, I get a lot of questions. Like today I was on a Zoom call, and everybody that's doing some kind of value add component or construction, they kind of have the idea, like they understand a little bit about SBA, but they got to kind of grasp this picture is that SBA, if you're doing any kind of construction, that you need permits and plans, everything pretty much queued up before SBA is going to fund the loan, right? On any type of construction loan. Because, for example, I had a guy today who wants to buy a restaurant, but he needs to do $300,000 or $400,000 improvements or remodeling. He can't finance those costs unless there's plans, there's permits, there's a GC that's been signed off by the lender. I mean, do you run into that commonly, like where people are doing, like they want to buy land and they want to build, but they have to understand they have to be pretty much shovel ready before SBA will actually fund the loan. Is that pretty accurate? Well, unfortunately, COVID has really messed things up as far as construction goes. It runs the gamut, Bo, where one municipality, it may take 6 months to get a building permit, others 30 days or 2 weeks or whatever. So every time, like personally, when I start a construction loan, the first question I ask is, where are you at in the process? Have you got a GC? Has the general contractor applied for permits? So we do like to see it in place before we start the loan process. Now, if they tell us that we've applied for permits and it's going to take 2 months, in a situation like that, if they've got a strong budget from the contractor, we can move forward. If we know by the time we close that we're going to have permits and everything, then we can start the loan process. Yeah, I guess the point I was trying to stress to the viewers is that we can't close an SBA loan or construction loan without all these pieces in place. So oftentimes people think, oh, well, I can acquire the land and then I can get financing, but all the pieces have to be up front, we don't close on the land and then you get the financing. It's all in one. So you have to, if you're going to be buying something that you're building, you're going to have to either do an extended escrow period so you can get your plans approved, or pay cash or get a loan on the land. And then when your plans are approved, then you would utilize an SBA 504 loan at that time. And also, I had a deal where they had previously purchased the land, and we were able to refinance the land into the new loan. So, they can buy the land ahead of time. Yes. If somebody's going to build a ground-up self-storage facility. Yeah, because a lot of people call me and they're like, just thinking about the idea of buying a self-storage and building a self-storage. Well, that's great. And I think the number one thing to do is if you can tie up that land and give you enough runway to get plans approved prior to you closing on the purchase, then you could put an SBA loan in place possibly. And that would be the easiest. Or if you have cash, you can close with cash and then potentially refinance with the SBA, just like Carrie talked about. But you have to have made progress. It's not like you can just buy a piece of raw dirt and then close on it with the SBA. You have to have an entitled property. So I just want to stress that because a lot of people don't realize that's how it's got to work. So when you're writing an offer, you got to know, hey, well, it's going to take 2 months it's going to take a month to get my architect, take another 2 months to get approved. So I need to write a 5-month purchase agreement. I close in 5 months versus I close in 30 days. So just so the expectations are realistic for everybody, because you have to have all these pieces dialed in for the underwriter, who's the GC, their resume, their insurance, all that stuff. That all has to be dialed in. But that's, if it's a 2-month process, that's what Carrie's facilitating with you during the process. But if you're just way out there, you're not going to get, you can't get a loan approved. You can get some good feedback, but that's the reality of it. You have to be at that point. So diving back into self-storage facilities. The other reason, now, if you're an existing owner of a self-storage facility and you're now want to go build a new one, and you've got 2 years at this location, you're going to keep the location, but you want to go build in another market. You have the experience now and the cash flow, let's say, from your existing business, where you can get, that's not considered a startup at that point. So I could potentially get 90% of total costs on a brand new construction project.
That is correct. And in some cases, you may be able to use the equity in your existing building as the injection for the new property.
How would that be with like a cross collateral?
Every deal is case by case, but there's some, let's say there's existing debt on the current facility. And depending how the corporate structure is, if there's different LLCs, they can be co-borrowers on the same loan, and we would refinance the debt on the first property, then use that equity for the new facility.
Got it. And collectively, because the people that are doing self-storage, SBA guidelines say you can have out up to $5 million in SBA financing. So that would be just the second mortgage lien. You'd have, on a 504, if you did $1 million, you'd have a $400,000 second lien. So you could have up to $5 million essentially in collective SBA loans, not counting the first senior bank loan, but actually SBA loans. But if you grow too big, you can also incorporate the 504 green, which lets you have $16.5 million collectively of SBA, which is like 40 million of buying or building power collectively. So there are ways to really grow. I mean, you can really grow quite a business with SBA by utilizing SBA with this self-storage business.
Oh, that is so true. And banks love self-storage facilities. I mean, it's just it's low risk. Most of them, if you have a good operator, most of them cash flow. So they're very good in a bank's portfolio, self-storage.
So let's rewind a little bit. We had talked about somebody that didn't have experience, had a business experience, but not business experience with self-storage, but they want to build a ground up facility. Is that usually going to cap them because it's at 80%, or if they have a management company already dialed in, could they potentially get 90?
They could. Well, let me think about that for a second, because that's going to be a startup. So that would be 15% down. That would be considered a startup. So if it's
15% down for startups, now it's 20% down if it's like a special purpose type of building, right? Like a 20, and it's a startup.
That is correct, but self-storage is really not considered a special purpose property. It is, however, I think there's if it's cold storage and over 50% cold storage, that is considered special use. But just dry self-storage is not considered special use.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Bo Eckstein, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. Do you guys, is cold storage actually SBA financeable? If
it is, but it's considered. I think the cutoff, if it's over 50%, that is considered special use. But it is SBA eligible.
Okay, good to know, because I have a list of a lot of. I didn't know that. Okay, well, I probably could have assumed that, but I just never thought about it, I guess. All right, so let's kind of put all the pieces together. So if you're buying an existing self-storage facility, what you'd want to get is 3 years of the seller's tax returns and a year-to-date interim financial statement.
That is correct. And
Rent roll.
Rent roll as well. And then, of course, that rent roll should show the occupancy. And the rent roll should also show the various sizes of units and how many they have. So that normally that's all included on the rent roll.
Okay. So from there, then for sizing these deals up, we know we can then pretty much figure out what our loan proceeds would be. And Carrie can run a quick analysis to see if the cash flow would debt coverage the new loan for the buyer, right? So a buyer comes in, you always got to remember that on an SBA deal, and correct me if I'm wrong, that for underwriting purposes, they always need tax returns of the seller on the business.
Yes, because those are considered the source documents, and it would be great if we could underwrite off financials, but tax returns are considered source documents because they're sent to the IRS.
So
and normally CPA prepared.
Yeah. So there's no way of just getting a P&L to close the deal. You actually need tax returns.
Yes, correct.
Okay. And the other thing too is, like, if you have on your financials that the seller gives you, you got to make sure, because I ran into this problem before, was the seller had commingled P&L with his other property. And that, like, he had, both of them were in the same P&L, and that's a no-no. You have to have them all separated. SBA will not like seeing a commingled P&L. Like, it was a assisted living, and he had one P&L for two properties, and it was like, okay. Yeah, and I couldn't get it funded because I could have funded it, but they needed to separate the P&L for each of the healthcare facilities.
Exactly right. And if it's consolidated tax return, like you just spoke of, Bo, an underwriter is going to want to see, of course, financials for the property that's being purchased, and then the financials for the other property, so they all tie to that consolidated tax return. So as long as all those sets of financials and tie to the consolidated tax return, normally that's okay.
All right. So now we know we need 3 years of 3 years and a year, 3 years of business tax returns from the seller and a year-to-date statement from the seller on the P&L. For you, the borrower, you need 3 years of personal tax returns, 3 years of business tax return, and a year-to-date statement on any businesses that you do have. You basically need a couple other forms would be a form 413, which is a personal financial statement. Any other businesses that you have, there's a debt schedule form you have to fill out, a resume, and what else am I missing? That's for initial sizing. That's pretty much what we need, right?
Yes, and that list of documents it may sound complex or whatever, but
it's easy.
Exactly, because like what I do and what most banks do, well, they have a short checklist of items needed to do an initial credit analysis, and but initially that list it's probably 7-8 items, 7-8 things.
Yeah. Actually, I use this new system, and I have it all like the form 413, and it's all there. I just email it right to the client. I got to show you what I do now. It's so slick, and then they upload it right back. But anyways, it's easy. It's not complicated. It seems complicated when you first think about it, but the SBA process isn't complicated. Now, okay, so Carrie gets the financials back. So we have an initial conversation where you call Bo, and Bo says, okay, let's call Carrie after I hear the deal. I said, Carrie's the best fit for this deal. We set up a call with Carrie. Maybe I have some information that we share with Carrie beforehand. We have a conference call. We talk about the deal. Carrie looks at the financials of the property. He figures out the debt coverage is good, that the property's cash flow will support your loan request. We know you got good credit. You got good financials. Maybe you're a W-2 employer or whatever. Your financials are good. Then Carrie sends the rest of the checklist. He submits the file to underwriting. Typically in 5 to 7 days, they come back with a loan commitment. From there, Carrie's already engaging. Once you look at the loan commitment and want to move forward, you sign the commitment. But at the same time, Carrie also, or I work with a third party that is the nonprofit that essentially works with SBA, which is called a CDC. On an SBA 504 loan, there's two pieces. There's the bank piece, which is the first lien, and then there's the CDC or the second lien. So on a 504, there's an underwriting process done by the bank, and there's an underwriting process done by SBA. So in conjunction, once Carrie packages up, he gets a CDC involved, or perhaps you already have a CDC involved. It's probably better to use a resourceful banker that's got really good relationships with CDCs, just because they mesh well together. It'll just flow better. So it's usually better to go to a Carrie first than go to a CDC, just my opinion. Because the biggest piece of it is making sure you got the bank lined up beforehand. So once the file is underwritten from Carrie's bank, the CDC gets it, they ship it to SBA. That takes 3 or 4 weeks, depending on how busy they are, maybe longer. And then they come back with their approval. Right, Carrie? So then your bank knows that CDC has approved it too. So then Carrie's bank works to get all the prior to document conditions ready, whatever those conditions may be, the appraisal, third-party inspection reports. And then loan documents are prepared. The borrower signs the documents, right? Okay, and then the deal is funded. So at this point, SBA hasn't really gotten involved. They don't fund the deal, they actually guarantee the loan. So the CDC hasn't yet bought the loan yet. So Carrie's bank is funding the first and the second loan at this point. Once the deal is recorded and closed, then what happens is there's a debenture that happens anywhere from 30 to 60 days, usually after certificate of occupancy. You're buying a stabilized property, so there's no really certificate of occupancy. You already have occupancy. So the debenture would essentially happen between 30 to 60 days of close of escrow. So you actually have your second loan in the beginning is actually like an interim bridge piece. It's not the SBA piece at that time. But after the debenture happens, that's where that second lien becomes a fixed rate, 25-year fixed rate at whatever the rate is. Today, the rate might be 3.07, straight 25-year fixed rate. And that's 40% of the total loan amount. Carrie's bank retains the first lien, the senior lien, and that's 50% of the total loan proceeds. So that's 50 plus 40 equals 90% of total cost. That's how we do it. So the banks like these type of loans because Carrie's bank, then after the debenture happens, they have a 50% or less than 50% loan to value loan. So it's very secure for them. The SBA is guaranteeing the CDC or the CDC's investors. They're guaranteeing a certain percentage of that loan. So those investors like it too. So the SBA is continuing to grow, especially over the last 2 years. There's doing more volume now than ever before. And I believe it's going to continue to grow as more and more people want to start businesses, want to grow businesses. But did I do a pretty good, accurate job there, Carrie?
You did, Bo. And one reason for the growth was all the incentives that we had last year, the CARES Act incentives. However, in the case of 504s, the refinance guidelines were recently enhanced, and I think they went into place like July 29th. For some reason, that date sticks in mind. So 504s will expand too, just based on the new refinance guidelines that were put in place.
Yeah, because now you can also refinance. You can refinance a SBA 7A into a 504. So you go from a variable rate loan, which is based on Wall Street Journal index plus your margin, and it's typically a floating rate somewhere in the 6s right now. You can actually, if you qualify, refinance into a 504. And on a 504, the second piece is a 25-year fixed rate. banks, commercial banks, if you ever have looked at commercial financing, if they offer a 25 or a 30-year loan, it's typically not fixed for 25 or 30-year loan. Commercial loans are always fixed for 5, maybe 7 years, and then they go adjustable. So the senior piece, like a Carrie's Bank, for example, it would be a 6-year or a 5-year fix amortized over 30. Not all banks do 30-year amortization, which is huge for cash flow, right? The longer the period of the loan is extended, the shorter the less expensive, or the more the loan's extended, your monthly debt payment's less. And if you're looking for cash flow, we always look for the longest amortization possible.
And Bo, that is correct. And for example, our bank, we do offer 30-year amortization. And also our rates are good too. So those two components combined, somebody who has a real estate 7A paying a high rate at a 25-year term, they could significantly lower their payments. So I mean, self-storage is kind of a given. If you're investing in self-storage, if you own and operate self-storage, or you're looking to get in self-storage business, it's probably a lot easier if you're looking to get in the business to actually buy an existing business with cash flow. I think the opportunity right now, is to buy mom and pop businesses. They're going out of business or they're retiring. And I think there's a tremendous opportunity for investors that want to run their own business to buy self-storage right now. So that's, something to look at. I get a lot of calls for financing, and there's a lot of upside on those businesses because been run by, husband and wife or whatever for 20 years, and they don't have the best technology. Maybe they're not marketing it correct. So I think there's a huge push for self-storage with people out there, investors, and you can use technology to kind of it's a little bit more passive, where you don't have to be hands-on as much as you used to in the olden days. So it's a really good opportunity, and to be able to connect in with kind and get some of the highest and best financing terms out there. It's just kind of a no-brainer if you can if you kind of meet the boxes for SBA financing. Typically that's 680 credit score or better. You probably have to show some security, meaning some assets and so forth. They're looking at you kind of holistically as the strength of the borrower. I don't know how much like current income has to play if I'm buying a self-storage facility and I make $30,000 a year as a bus driver, and I'm buying a $2 million property or $1 million property. The creditworthiness still has to be there. How much weight are you going to put on the actual borrower, like their financial picture, like their net worth, so forth, Gary? Like, that's kind of a good question. Like, if they're a W-2 employee, maybe they're make 50, 70, 80 grand a year. They have the 10% of costs and a little bit of reserves, but that's maybe they own a home. SBAs, they're pretty liberal though. I mean, as far as what are they going to look at the borrower? I mean, obviously using the cash flow from the business, they're more looking at the cash flow of the existing business versus me personally. I mean, they're going to look at my creditworthiness and stuff, but how much weight do they put on reserves and all the other components? Well, Bo, every deal is case by case. And getting back to your example where the bus driver making $30,000 a year, we would hope that his wife's an attorney or a doctor or something to have that extra income. I'm just kidding. But anyway, like I said, every deal is case by case. And I mean, getting back to the bus driver again, maybe he has a family member who can come in as a partner or something that has a strong net worth. I mean, that might be a situation where they could bring in a family member and make the deal more solid. So there are so many different ways to structure the deals based on, and you're right, the reserves are important. Outside income is important. So we would hope with a borrower that has limited net worth and limited liquidity, they could bring a family member or some kind of strong partner into the deal. Yeah,
Carrie and I were working on a deal, and I watched how creative Carrie was. For net worth, bringing in like potentially like a family member's gift. I mean, Carrie's going to get the whole thing about lending is like, even if you're not quite there, what can we do for compensating factors, right? Like maybe your net worth's not there. Maybe you find the right partner. Maybe, maybe there's a portion, maybe you get the seller to carry back a portion to lower the loan proceeds so the debt coverage is way higher. There's just lots of creativity. And actually SBA, they're pretty flexible. I mean, they're not for certain things, but if you can mold a deal, they're trying to help small business owners essentially the best they can. I think so.
And that's the goal of SBA, Bo, is to grow entrepreneurship and to help those folks who can't get a loan at a local bank or something. So I always say, because I guess because I'm biased, but 504 loans are the best commercial real estate financing available out in the market today.
I like that. That was good. We'll probably have to edit that and put that in the front of the video. That was a good.
Right.
So as we're winding down here, and guys, we're going to be doing a segment I just talked to Carrie before that we got on air, and I said, let's just do one segment a month because people love this stuff and Carrie's a wealth of information. But some key takeaways on self-storage deals, any kind of things that people might, any points if they're looking at buying self-storage, any red flags to run away from other than, obviously if it's not cash flowing?
Well, we've already touched upon it, but self-storage is one of the few industries where somebody who doesn't have that specific experience can actually get in and purchase a property, with 10% down, as long as they've got a good solid management company where the management company's agreement is approved by the SBA. So that's very few industries would allow somebody with no experience to come in and buy a property like that.
That is great, by the way. The more I think about it, because like, for example, like when people are trying to buy multifamily property and you try to get a Fannie or Freddie like agency for a big multifamily, I'm talking, 20, 30, 50 units. They will not make a loan unless you have own similar assets. So that's great that SBA for self-storage, because that, a lot of people are looking for businesses to own, and self-storage would be, ideally would be the right business because it's potentially could be less, less hours worked. Like there, you could do a lot of stuff remote. So I think that was a great point, but go ahead. You were going to say something else.
Oh, I lost my train of thought. One thing we didn't talk about is I have a client who's an experienced operator, and he seeks out properties that aren't cash flowing. This could be due to several reasons. The owner's going to retire; he's not marketing or anything. And in one case, he was renting out a bunch of units to family members, so he didn't get any income. And this client of mine will purchase these properties and turn them around with his expertise in marketing and everything. So that's another case where self-storage, once you become an experienced operator, you can look for those opportunities like that.
Yeah, I like it. I love it. Well, Carrie, thank you again. We'll have to discuss what our next topic will be about, but self-storage is definitely a hot topic. And I think people that find this on YouTube or through my newsletter are going to find a lot of value out of it. So I appreciate your time again.
Well, Bo, once again, I appreciate you inviting me to these podcasts and getting the word out on 504 loans.
Yes, thank you. All right. Well, maybe what we could do is bring on a CDC lender next time and have Carrie, myself, and a CDC lender do a little 504 day and talk all about the CDC, how they work with the banks. I think that would be interesting for people too. But we'll Absolutely. Talk about that. Yeah, thank you. All right, everybody, please like, subscribe. And if you want to book a call with me, I will have a calendar link. I will put Carrie's information down below as well. And thank you for being a loyal fan of the show. See you guys next time.
Thank you. Thanks, Bo.
Hey guys, Bo Exian here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.